Hi, everybody. Let's have a little look at how everything ended today. It's Thursday, June 30th. So number one, it's the last trading day of the month. So there's always a little bit more buying and selling, just an uptick in volume on the last trading days of every month. But not to mention, it's also the last trading day of the quarter. So Q2, second quarter of 2022, has come to an end today. And so that also adds to that volume. So we've seen, things were okay today. A little bit of up, a little bit of down, but certainly some interesting activity today. So not too uncommon to be the last trading day of the month as well as the quarter. So we saw, I would say a pretty regular day related to that. A couple of things to look at. Let's just kind of keep in mind where we are, and this will matter for a couple of things that I'm going to mention. We're sitting a little bit on the sidelines. We're just being careful. We're being cautious. We're letting this sentiment turn. There's a lot of bearish sentiment out there. And let's talk about some of the reasons why that is. This bearish sentiment, or this really downbeat, downtrodden sentiment of the market goes lower, everything goes to zero, the stock market ceases to exist, right? I have traded through a lot of these types of situations. Whether it be 2000 with the crash of the internet stocks, the dot-com bust of 2000, or the housing crisis and the Great Recession of 2008 and 9. And I remember as we get to the lows of these moves, it can feel very negative, very much like the stock market never comes back, it never recovers from here. But let's look at a couple of interesting numbers. First of all, the S&P, the U.S., United States stock market, the S&P 500 that looks at the 500 most valuable stocks in the U.S., is down. This is a high of about January, the first week of January this year, 2022, to the low, which actually happened about almost 2 weeks ago, about January 17th. That's a high to low dip, as you can see right there, of about 24.5, almost 24.6%. So creeping up on 25%. Now, bear market in the stock market is any correction, any move down more than 20%. So anytime we trigger a bear market, that starts to get people's attention, that starts to get people concerned, that starts all of that stuff. So that's number one. Number two, let's look at the NASDAQ. Now remember, the difference from the S&P is just looking at the 500 most valuable stocks. Now the S&P does include a lot of tech stocks because some of the tech stocks have been the most valuable stocks, like Apple, like Microsoft, Amazon. These are making up a very large portion of the S&P. They're weighted by their market cap, their value. And so for the last couple of years, 5 or 6 or 7 stocks, the ones we've heard about, Tesla, Microsoft, Netflix, Apple, Facebook, now Meta, have made up a large portion of the S&P 500. It's made up a large portion in weight of these 500 stocks. So just a little look at that S&P situation there. Let's look at the NASDAQ. Now the NASDAQ, of course, is just mostly tech stocks. Now, why are we bringing up and making sure we're clear on this tech stock move or just overall stock move? Because this tech stocks have been hit the most, right? Tech stocks are, PayPal and Apple's and Netflix and Google's and so on. Now, the big established companies have done a little better. Apple and Microsoft are down less than PayPal, Netflix. They've taken huge hits. But overall, if you average it out across the NASDAQ, that basically is just looking at these tech stocks. We've seen the NASDAQ from the high here of about November to the low here of about middle of June. We've seen basically a 34% drop. So the S&P is down about 25% and the NASDAQ's down about 34%. So tech stocks specifically are down more than the rest. The S&P includes energy stocks and so on, and so those have been doing well. Our material stocks have been doing well until just recently. They've had their sell-off. So that's why the S&P's held up a little bit better than the NASDAQ. So Why is all of this happening? How is all of this happening? A lot of things, right? Number one, if we look at the high of the NASDAQ, which is right here, that tells us in November is when it was at its highest point, and it's only been coming down ever since, right? So November, and we've seen it coming down ever since. And this is when the Fed said, inflation is a problem, it's not transitory, it's here to stay. And so we start to see stocks selling off. We start to see things happening from there. Why is that? Remember that inflation means that there's, too much money out there chasing too few goods. Now, there's a couple of kinds of inflation, and I want to kind of talk about what those are in just a moment. But when inflation goes up, everything gets more expensive, and really the only tools that the Federal Reserve has is to make money more expensive. So there's less money out there. So there's not so much money chasing so many goods. And so by raising rates, now these companies, all these companies, especially some of these tech companies that sell software, are betting on growth. They're borrowing a lot of money to grow. The money is cheap, so it's easy to pay back. It's not a huge burden. And they can reinvest all profits into growth. So a lot of these tech companies are not profitable, or barely profitable, but they're borrowing money because it's so cheap to borrow, and they're putting everything into growth, into just making a company huge, right? Well, when that money gets more expensive, all of a sudden the business model that these companies have does not work so well, because now the money is more expensive, and now it costs a lot more money for them to borrow and to service their debt, and it doesn't make as much sense for these companies to be trading at the prices they're trading at when all of their money is reinvested and they really have no profits. And that's why we've seen these tech companies hit so hard over the last several months, 6, 7, 8 months. Now, interest rates are going up. How much are interest rates going up? Here is a tool. This is from the one of the exchanges here. This is the most commonly watched. Now, this chart might look a little bit crazy, but just work with me here for a moment. You can see some dates up here, right? The next Fed meeting where they're going to discuss interest rates is going to be July 27th, right? So that'll be the next meeting. And right now, what the market is betting on and voting on and so on is that there will be that interest rates will be going up to between 2.25% and 2.5%. 83% of the bets are showing that we're going to be headed for 2.25% to 2.5%. Only 16% of the bets are saying interest rates will just go up 0.5%, right? So interest rates right now are in this around 1.5%, and so this is a bet that interest rates will go up another 0.5% or 50 basis points. This is a bet saying that interest rates will go up 75 basis points or 0.75%. So really pretty well priced into the market that interest rates will be going up to that 2.25% to 2.5%. If we go all the way to the end of the year, here's September, November, here's December right here. If we go all the way to the end of the year, the highest bet right here, the market is pricing in and betting that interest rates will be at 3.25 to 3.5%, right? So we see that basically the market has priced in that interest rates will be going to about 3.5%, 3.25% to 3.5% by the end of the year. Now, just a reminder, U.S. interest rates right this moment, right? What is the current interest rate in the U.S.? It's 1.5 to 1.75%. There's kind of always that interesting little deviation there, but we're right at about just over 1.5% in the U.S. right now, and so the market is betting on basically that by the end of the year, interest rates will go up another 1.5 to 2%, probably 2%, right? So we're at around 1.5, and the market's betting on interest rates being around 3.5% by the end of the year. So we're not even halfway there as far as interest rates go, and we're halfway through the year. So just a couple of things to kind of keep an eye on. So this is what is getting all this recession concern going. Now, remember, everyone's worried about a recession and that things are going to get crazy and they're going to get wild and that nobody's going to be able to spend money and that we're going into a big hard time like we did in, say, the last big recession we had, which was 2008. Now, yes, we had a recession, a fairly short-lived recession in COVID for 2020, but it kind of happened and it kind of got over quick, right? So here is what the COVID sell-off looked like. It was very aggressive and very quick and recovered very quickly, right? Stock market went straight down, straight back up again. And so, as we know, that was a big surprise. There's this virus coming. Nobody knows, kind of what to expect and how this is all going to play out. Right now, we've seen much more of a gradual decline. It's aggressive, but it's still, pretty gradual, right? And so everybody is kind of looking at this as a situation that might be a little more similar to what we saw. This is what the chart looks like for the great housing crisis and the Great Recession in the U.S. from 2008, and onward. So here are kind of the highs of the stock market in 2007, and it was kind of working its way down, and then we got all this bad housing news, and it sold off really hard and really quick, and it took quite a long time before it got back to new highs and above new highs, whereas the COVID sell-off was straight down, straight back up, right? And so everyone's thinking, okay, are we going to have a long recovery like this one? Now, even if we do have a long recovery like this, the bottom of the market hit, and there was a real aggressive run higher, right? We had this really aggressive from the bottom to the next kind of pullback. The stock market ran up about 80% over the course of, this is March 2009. This is April 2010. So over the course of about a year, it ran up 80%. We had an 80% rally in the stock market. But it did take quite some time. It took all the way over here, all the way to 2013 before we took out previous highs over here. So it took a couple of years to do that, even though there were some strong rallies off those lows. Whereas COVID sold off very quickly over a couple of weeks, and it took out the highs a couple weeks later. So just kind of give a little context about how that works. So everybody is wondering, is this kind of recovery what we're going to see? Is it going to take a couple of years before we get out of this? Well, Morgan Stanley has some interesting news about this. Morgan Stanley, the investment bank in the U.S., had an interesting article, How Bad Could the Recession Be? If we look at any historical moves about how bad the recession could be, there's some interesting things here, right? So they talk about an inflation-driven versus a credit-driven recession. Sorry, I think I was saying inflation. I'm meaning recession. So they were talking about, here's the big difference of an inflation-driven recession versus a credit-driven recession. Now, 2008... as well as 2007, 2008, as well as 2000 and 2001, the internet, tech bubble. These were credit-driven recessions, meaning they were debt-related. Remember that in 2008, every janitor of a high school owned 4 houses, right? Every construction worker had 10 houses. Everybody had all these houses that they could not afford ultimately. And so there was this excess of debt that was unaffordable. The average person could not really afford the debt they had. The internet situation was the exact same, right? There were these companies that were trading at levels that were unrealistic. And there was financial obligations tied to that were unsustainable. So 2000 and 2008 were these debt-related recessions, right? And these took a long time to recover. It took a couple of years for 2008 to really make its full recovery. It took a long time for 2000 to make its full recovery. And so everybody that's saying that the market is like one of these two, these are different types of recessions. What we have a bit more of is an inflation-driven recession, right? And inflation-driven recessions are more like what we saw in the 70s and in the 80s, right? So 73 to 74 and 82 to 83 were inflation driven, meaning there was a lot of money. Everything else was pretty good. There was just a lot of money, right? And so the price of goods and services got very expensive. Inflation took off, and so a recession ultimately followed. Now, why does that matter, right? It's definitely important, if and these statistics are I think fairly well known. So this is nothing earth shattering. It's just very well laid out by Lisa Shallot here of Morgan Stanley. But the difference is interest rates went crazy in the 70s and in the 80s, but the S&P saw profit declines of 14 to 15% as opposed to declines of 50 percent, 57+% during the financial crisis of 2008 and the tech bubble, right? So we saw much larger declines from 2000, 2001, and 2008 and 9 as a credit-driven recession, whereas we saw much smaller declines from, and these are corporate profits, by the way, right? Not declines in the S&P. We just saw profits fell much less in an inflationary recession, as opposed to a credit-driven recession. So corporate profits dropped 14 to 15% during those inflation-related ones, and we saw 50+% during the credit-driven ones. So it looks like, for all intents and purposes, that we have much more of an inflation-driven recession happening right now. And how do we know that? We know that for a lot of reasons, right? Because we know that, number one, a lot of companies have very strong balance sheets. The banks are very well funded. The job market is rock solid. Anybody right now can go get a job anywhere, doing anything and making more money than they could have with those jobs over the past several years. So the job market's strong, corporate profits are strong, the real estate market is strong, even though mortgage rates are going up and everybody's getting pretty nervous about how that might play out in the real estate market. And of course, if mortgage rates go to 10% or 15% or whatever, that will certainly hurt the real estate market. But for right now, the real estate market is still very strong. Job market is still very strong. Banks and corporate profits are still very strong. So this is looking like it has the potential of being a far less severe recession than anybody has kind of anticipated. Now, one of the reasons that is the case is because, again, if we go back to interest rates right here, right? And we see that, by the end of the year, the market has priced in that the U.S. will be at about 3.5% interest rates. If the Fed doesn't feel like they need to go to 3.5% because inflation starts coming down, and I'm going to talk about some of the reasons why we're seeing some of that. If inflation starts coming down, then the Fed maybe doesn't need to go to 3.5%. And guess what? The Fed's going to have a heck of a time servicing its own debt at 3.5%. So the Fed doesn't want to go to 3.5%, but if they have to, I guess they will. And so there are some theories and some possible predictions that the Fed does not need to go to 3.5%, and that they'll change course somewhere along the way as long as there's signs that that the inflation situation is subsiding a little bit. And we're seeing that could be a massive catalyst on speeding up the recovery in the stock market, right? And that's why we may not need to see a long dip and a long recovery like we saw in 2008, because this was a credit-driven recession as opposed to inflation-driven recession, which is what we're seeing right now. So we've got this more inflation-driven recession, which could recover very quickly if we see inflation coming down. Inflation needs to come down, and we need to see interest rates slow down, right? Interest rates are trying to do this. If we see interest rates kind of do this, which is very possible as long as inflation comes down, then we could see the stock market do this, right? And have a very strong end of year. When we have seen the first half of the year go as badly as it's gone in the stock market right now, we have almost never seen in the history of the stock market an end of year that is worse. By end of year, it has always improved. This is one reason we have to stay very active in the stock market and very engaged, because could it go lower? Of course it could go a little bit lower, but history has shown that it's very, very unlikely that the end of the year will be any lower than it is by the middle of the year, which we're at right now. So we've seen a lot of destruction in equities, but we know that we have a different kind of potential recession, one that doesn't last as long and usually isn't quite so severe. If we go back over here to Morgan Stanley's report here, there's the discussion that bear markets and so on can be very big and ugly in these credit-driven recessions, but in inflation-driven recessions, they don't last as long and they're not as severe, and they tend to recover quite a bit more. So all of these things that we have seen with corporate profits and balance sheet and the labor market and the housing market staying strong means that it's very likely that this recession could be a little less severe. Now, not to say that seeing the stock market 25% off its highs and seeing the NASDAQ 35% off its highs and seeing a bunch of individual stocks that are 70 and 80% off their highs isn't severe. That's very severe. But the market is still kind of seemingly pricing in this ultimate destruction, and it looks like we're not going to get that. Now, some of the signs that we're seeing that the supply chain is easing up, remember, a lot of this inflation is due to supply chain issues. We have a lot of money that's been pumped into the system from all the COVID relief, and then we have this supply chain issue where people can't get what they want, and so there's all this money that's been pumped into the system, and there's far less goods out there. Well, we've seen that companies like Target, retailers like Target and Walmart have been announcing that there's higher rates of inventory. And this high rate of inventory is just one of the many signs that we're seeing that inflation is actually slowing. Now, part of it is due to the fact that during COVID, a lot of people moved out of big cities. They bought houses that push the housing market more. They had to furnish these houses, so the goods out there, the typical retailer goods, and the pandemic shopping was very, very strong as everybody was moving out of the cities and getting these houses. Well, now everyone's kind of moved out of the cities that wanted to move out. They furnished their houses, they bought their goods, and these retailers, who should be managing their inventory a little bit better, are still continuing to buy items that are really much more pandemic related, right? So they're starting to see, for example, Gap is reporting that customers are looking more for dresses and office clothes instead of fleece hoodies and activewear, things that you would wear when you're working from home. Now people are back in offices. And so they have this excess inventory of something that people wanted more a year or two ago than they want now. So that's got everyone's radar tripped about, well, retailers just have a bunch of stuff and nobody wants to buy it because inflation's too scary. A big part of it is retailers have a bunch of stuff that people wanted when they worked from home and when they couldn't leave and when everyone just kind of had to, stay close and not do a lot of traveling. Now that's changed. The pandemic is over. Lockdowns are over. Restrictions are done. Everyone's back in their offices. And so those items that people wanted then, they don't want so much now. Number one. Number two, it's also a positive sign that these retailers can get what they want to get, right? That's a good sign for freeing up of the supply chain and also being a good help for easing the inflation. Because inflation has really been a lot of supply chain issues along with other things, but supply chain issues have been a big factor. And so the more the supply chain opens up, the lower inflation goes, the less the Federal Reserve has to raise interest rates, the less pressure is on the stock market, and the more interested buyers become in the stock market, and the more quickly this recovery can happen. So the moral of the story is, we're being patient, we're being careful, we're being cautious, we're watching all the numbers that we need to watch, but we're also making sure that we are ready and engaged for when this recovery starts to happen. Those are the things that we need to be watching, but we're already seeing CPI numbers are starting to look like they're going down, these inflation-related numbers. Interest rates will be the next big thing. What does the Fed project with interest rates? Do we really get to 3.5% by the end of the year? If there's signs that we don't get to 3.5%, that will be pretty bullish for the stock market. So there's a little more patience involved, but getting money in place, having resources ready to jump on this market aggressively will be very, very important. We have a lot of great things happening. I hope that's helpful. Just my quick take on the market, a little look at what we have happening. I think we're definitely through about the worst of it. There might be a little more hesitancy to buy into stocks for fund managers. A lot of money is sitting on the sidelines waiting to see how things shake out. But it's very, very good to see some of these technical indicators. We've seen, a nice dip. We've seen a move back to some of these long-term moving averages. These are all good signs that tell us this has been a needed correction, a needed recovery. We've seen it. It's happened. The market sentiment is very down, and this is a great time for us to start getting even more engaged. I remember at the bottom of 2009 looking at the stock market and thinking, this is going to zero. And that was literally the last day it went down for a year. And so I think a lot of people out there feel like that, but that's a good sign because that means we're probably near or pretty near a bottom. So just a few thoughts I had about the market. I hope that's helpful. Good luck. Have a wonderful rest of your day, and questions, comments, let me know. I'm happy to discuss. Thanks and take care.